Now we're ready to move to the last section of today's conference, which is going to be a roundtable discussion, which is going to be moderated by Mr. Théodore Economou. Théodore, are you there?
I'm here, George. Ready?
Excellent. Excellent.
Ready.
Excellent. We cannot go on without our moderator. So Théodore is actually the co-organizer of today's conference. Théodore is a distinguished fellow at the Institute of Finance and Financial Regulation, and he has a very rich experience. Currently, he is a member of the investment committee of the Virginia Retirement System, one of the biggest pension funds in the world, and he's also an advisor to BAE pension scheme. In the past, he has served as CEO at Lombard Odier Investment Managers, and as CEO and CIO of the CERN Pension Fund. Théodore has also been involved in the discussion at the European level for a pan-European system, and in this role, he served as a secretary to the EU Resaver Task Force. There are also many other things that Théodore has in his rich resume, but we'll run out of time if I continue speaking about him. So, Théodore, the floor is over to you. Once again, many thanks for co-setting this wonderful conference. Thank you.
Thank you very much, George, and welcome everybody to this panel. If you haven't noticed so far, this IFFR conference that George and I organize has two unique features that give it an edge. It brings together a mix of not only asset owners and asset managers, as many conferences do, but it also brings in academics and regulators. And second, it aims to offer unique insights that you can't get anywhere else on topics that are relevant, timely, and often and intentionally somewhat controversial. And this panel will follow exactly this recipe. We'll talk about regulation successes and failures. We'll talk about ESG successes and failures. We'll talk about what needs to change in asset allocation, modeling, and how best practice is changing. So hang on for advice that I can promise you won't hear anywhere else, coming from a panelist lineup which I can only describe as all-star. I'll start with Bernard Delbecque on the far right. He's joining us from Brussels, Belgium. For the past 6 years, he's been chair of the Occupational Pension Stakeholders Group at EIOPA, the European Insurance and Occupational Pension Authority, which de facto is a defining body in setting pension policy across the EU. He's also director of research at EFAMA, the European Fund and Asset Managers Association. He has extensive experience in government on both sides of the Atlantic. He's advised the Minister of Finance in Belgium. He's worked for the IMF in Washington. So truly an irreplaceable perspective on the world of government regulation and global economic policy. Welcome, Bernard. Then Martin Roth, CEO of Pensionskasse Manor, in the middle of your screens, joins us from Basel, Switzerland. Last month, if you didn't know, the pension fund of Manor, which is headed by Martin, won Best European Corporate Pension Fund for 2023 at the Investments and Pensions Europe Annual Awards, and that's probably the most coveted industry award in pension asset management. So congratulations, Martin.
Thank you.
Since 2022, Martin has also been chairman of ACIP, the Swiss advocacy organization that represents more than 1 trillion, the trillion with a T, in pension assets in the Swiss capitalized pension system. Martin has experience in the asset management side too. He had a stellar 15-year career at UBS, and also in academics, he teaches a course in asset management for pension funds at University of Lucerne. I'm really honored that Martin is joining us. Welcome, Martin.
Thank you.
Kondakis, and then on the right is Chief Investment Officer for Piraeus Asset Management. That's Greece's highest AUM pension fund AUM manager in Greece. He has 20 plus years of career managing assets and has delivered in the past decade constant outperformance, and we'll talk about this and the reasons. In 2022, among others, his flagship Greek equity fund, which is also the largest in the country, ranked #1 among Greek equity funds. And so his firm importantly also has the highest AUM in ESG mutual funds, and we'll get some terrific insights from that. Welcome, Kostas. And
thank you very much. Thank you.
Washington, D.C. Bottom left on your screens is Sudhir Rajkumar. Sudhir chairs the International Center for Pension Management, which is an organization grouping pension fund asset owners representing more than $6 trillion, including most of the world's mega pension funds, literally from around the globe. I had the distinct pleasure of meeting Sudhir first when he was Chief Executive Officer of the Investment Management Office of the Pension Fund of the United Nations in New York. And that's a 70 billion pension fund, 85% managed in-house and heavily watched by the entire industry. Sudhir has 30 years career in investments, including at the World Bank Treasury, where he actively advised on establishing best practices for investment operations of pension funds. And that's why he remains highly sought after as a board member and investment committee member at pension funds worldwide. Welcome, Sudhir. We're honored to have you. Now, let me move on to the meat of this panel, and I'll touch on a topic that hasn't been discussed this year, although it was heavily discussed in prior years, which is ESG. ESG had an important development in the past year, 2023. Performance was absolutely terrible. And this was just at a time when most asset owners and asset managers had implemented such ESG strategies, sometimes heavily hyped. Let me turn to Kostas. What went wrong in the ESG space in 2023?
Right. Thanks a lot, Théodore, for giving me the opportunity to outline the basic reasons and the drivers for this underperformance, which is objectively so. But first of all, we need to set the timetable of this underperformance. I mean, if we look in the past 2 years, yes, indeed, there is underperformance. But if we take it to a longer time horizon, let's say 5 years, then there is strong evidence that ESG overperforms the markets and other kinds of models also, modeling. However, in 2022, ESG funds were heavily invested in growth and tech stocks, which are long duration stocks, because of their relatively low carbon footprint and a relatively good ESG score. These funds underperform, as we all know, compared to conventional funds due to supply chain inefficiencies and which were due to geopolitical events such as the war in Ukraine, which led to increased energy and raw material prices, which in turn led to cost inflation and increased cost of capital. Tech stocks and clean energy, renewable energy manufacturers like Vestas and Ørsted were severely hit. And on the flip side, fossil fuel and defense stocks benefited the most with ample profits for asset managers. Therefore, it is not the ESG factor as itself that drove the underperformance, in my opinion, but rather specific events that one can argue are not recurring every year, or they're not consistent for us to form a completely different asset allocation strategy away from ESG. ESG, in my view, is something much larger than just 2 years of underperformance. It is something that is very crucial for occupational funds as well. We don't forget we are in an occupational funds conference at the moment, meaning that occupational funds receive funds from society, from people, and through good practices and ESG integration into their modeling, I am pretty sure they give back some of the positive externalities that this creates into the society as a whole. And for this,
thank you, Kostas. There was very clear explanation. So what you're telling us, 2023 was a point in time. But I'd like to push you a little bit on this, please, because we've been talking about ESG which presupposes a definition for what is ESG. And that's another area that's proven where we've had significant developments in 2023 because it's proven extremely challenging. We have seen massive downgrades from asset managers who had self-classified funds of Article 9 down to Article 8. And we have seen defense, which you just mentioned, just being accepted as ESG by one of the leading players, SEB in Sweden. I'm very confused. It feels like chaos. Where do you stand, Kostas?
Yes, you are completely right on this, Théodore. There is, in my view, we are in the very beginning of this ESG world, because regulation, there is a classical case, in my view, that regulation has just got the cart before the horse, as we say in English, meaning that they have set very strict regulations and rules and norms in what a fund needs in order to be characterized as Article 9 compared to Article 8 or even Article 6. But at the same time, the data has not followed this regulation because of timing. There needs to be a lot of work before companies are ready to disclose ESG data as the EU taxonomy, let's say, regulation requires them to. So we find ourselves behind because there is no available data. One reason is the data.
Yes. Regulation got ahead. I like your expression. The regulator, obviously at the EU level, got ahead of reality. I'd like to hear from a voice outside the EU. Martin, you represent $1 trillion in ESG funds, actually more than 1 trillion because it's in Swiss francs, given the current exchange rate. What's the picture from Switzerland? You're outside the EU. What does it take for ESG? You have the same pressures, and what does it take for ESG to work? Martin, we can hear you. Please press.
Of course, I mean, of course, ESG is also a very popular topic in Switzerland. I think we all agree that it's here to stay. So, but we did that from the Swiss Pension Association already in the past. We are strong believers in smart self-regulation. So, what we worked on in a working group with pension funds, but also with the Swiss Asset Management Association, with the CFA Institute, we defined our self-regulating reporting. And we published this reporting, the reporting guidelines back in December 22, and telling our members that they should try to implement an ESG reporting for the year 23. So all of our members at the moment are working on this reporting, and the feedback so far, if I compare it a bit to the EU regulation, has been pretty positive, because most of the feedback we received so far is that it's lean. It has different levels of reporting. When you are a small pension fund, you have a basic reporting. When you are a government-owned pension fund, there's an advanced reporting, which is, of course, far more extensive. And so far, also from our members, we had a positive feedback. And our hope, of course, is that the regulator will, we are already in conversation with the regulator, that they will define their reporting demands according to the reporting we developed. This already happened in the past in other parts of the portfolio. So I think self-regulation is less bureaucratic, and you have far more acceptance by the members itself.
And it seems that you got, so bottom up beats top down. That's the message I'm getting.
Yep. Definitely.
Bernard, I have many questions for you on regulation. Do you want to pitch in on this? You've been at the center of this bottom-up versus top-down debate in many areas, including any lesson on ESG?
Yeah, I mean, you know, I agree about what was said, the data issue, the timing issue, also the fact that you mentioned Article 8 and Article 9, but, you know, they were, their role was about disclosure, and they were not supposed to be labeled, and they've been used as labels. So there is clearly a need just to move toward, there was a well-defined categorization system, right? So, and just one other aspect was just mentioned is transition finance. You know, the SFDR in Europe is being now rediscussed, and I think that there is a need just to integrate this concept into the discussion, because you know, there is also a need to help companies that are doing that are moving towards a sustainable business model, rather than just focusing on the companies that are already sustainable.
Very, very clear. So good to hear. EU is apparently listening to this, right? And so regulation could evolve. That's what I'm hearing, and certainly a topic we should revisit at a future event. I'd like to move on, still stay in the realm of regulation, and move on a little bit, and contrasting EU versus US a little bit. One of the edges, in my experience, that in pension system work that the United States has against Europe is that you can, you know, be a participant in a pension plan in New York, move to Oklahoma, nothing will change, right? We don't have this in Europe, and this, I believe, EU is very well aware of this. And 5 years ago, we had a potential solution announced, which was so-called PEP. Pan-European Personal Pension Product, right? I followed this very carefully, and my impression is that it has gone absolutely nowhere. So in this case, an example of regulation that was not imposed, it was offered, it opened what could be a new world, but it has not worked. That's what I conclude. Bernard, why can't the EU get a pan-European pension fund to work? That seems fairly easy.
Yeah, I mean, you're right, it doesn't work. There's only one provider so far that has launched the PEP, just one. And it's very disappointing, because this product would have been improved the image of Europe, especially towards the younger generation, because it's a portable product. I mean, the main issue is, you know, it's probably, you know, is the fact that there is a 1% fee cap. And the problem with the fee cap, it is that the PEP is a personal pensions product, which means that the provider needs to sign individual contracts with an interested person. They must also provide personalized financial advice. And all these within a total fee cap of less than 1%. It's the MEPs that, you know, requested that at the end of the negotiation, because they thought that too many of their proposals had not been accepted, and the European Commission was against the fee cap, but, you know, it was adopted. And also it was adopted in relation to the 75 basis point, you know, charge cap that exists in the UK on some default option in pension funds. The problem is that these 75 basis points are related to occupational pension scheme and not to personal pension product. Then Théodore, there are two other, I must say, I mean, there are two other issues, right, that were kind of well known, that would have nevertheless explained that the takeoff would have been slow, is that this is a new product in any case, even without the fee cap. So there is uncertainty about the potential demand for this product, and this product needs to compete with the existing personal pensions product. And the market there is dominated by the insurance industry in the third pillar market. And it's no secret that insurers there were not very, big fans of the PEP, because there's more competition in the PEP. Because one good thing also about the PEP is that asset managers and pension funds can offer the PEP. And then there is also the disparity between national tax rules that makes, of course, the portability more difficult. So just for all these reasons, we're not hopeful.
Please explain these tax rules, because this is, I believe, a topic that's very relevant and timely.
Yeah, I mean, you know, it's the product. Usually, the product are just you know, domiciled in a country, sold within the same country, right? In Europe, so we're not in the United States of Europe. You know, that's especially in the pension area. But with the PEP, there is a need, an obligation for the provider also just to provide, to ensure the portability from one member state to another one. Once the saver is moving, you know, from Brussels to Rome. But you have tax incentives that are, you know, provided by the Belgian authorities, you know, some conditions that are given just to obtain this tax advantage in Belgium. And then the idea was that the saver could move to Rome with the back, you know, in his back, we'd have the assets that are being with him, but that are falling under a different tax regime. Maybe in some countries it's EET, maybe in other countries it's TEE. So there's kind of a need for the providers just to jungle, you know, with all this, and to know what are the rules that are being applied. And sometimes the condition also, for instance, in terms of the payout that is being offered, linked, do you need to have an annuities, or can you have lump sum? Maybe the rules in Belgium are different than in Italy. So there's a bit of complexity. This being said, we always thought that, you know, with more transparency and effort, and of course, a move towards harmonization, you know, we know it's difficult, but, you know, that the PEP could take off. We still believe that this is the case. But, you know, if you have all these difficulties, plus the personalized financial advice that you need to give to your clients, in a personal pensions product where people would save little amount of money rather than compared to what is available in the occupational space, then things are, you know, too difficult. So the fee cap needs to be reviewed.
Very clear. The clash between EU and member states is also impacting.
Also, yeah.
Right. So something to monitor. Now, this conference is called, in this title, the Conference on Pension Asset Management. And so I propose that we now move into the world of actual asset management. And to set the stage, let's look at, you know, what worked in the past. And we have a winner participating, who is Martin. Martin, what was the secret of your success to winning Best European Pension Fund in asset management performance?
Thanks, Théodore. I think it's not that we have neither a crystal ball nor a secret sauce. Maybe I start with explaining you a bit about the pension fund Manor itself. We are a retail store department chain, the biggest in Switzerland. Some might argue it's the only one left. We're a family-owned business. We belong to the Mausfrère holding, which owns, amongst others, Lacoste and Gant, so a pretty significant player in the retail space. We do have around 9,000 members. Our assets are 2 billion, and our coverage ratio at the moment is around 124. So it's a very solid pension fund, and where we deviate from an average Swiss pension fund is that we have very little bonds. Our bond exposure used to be below 5%. We reduced dramatically. An average Swiss pension fund would have around 35% in fixed income. We reduced that quota, started back in 2013. Then the obvious question is, where do you invest the bond quota? And we invested most of it in private markets, in alternative investments. We do have a hedge fund. Overall, we have around 25% in alternative assets, 15% in hedge funds, and the rest is in infrastructure, private equity, foreign real estate. So quite a broad mix, and we are a very fond believer of diversification. And if we look at our results over the last 10 years, probably also the reason why we won the award in Switzerland, we're in the 98th percentile, so top 2% of Switzerland. Performance, of course, after cost, and we also challenged ourselves, looking in the rear view mirror. Was it worth it? And we simulated our portfolio as we have it now, as we held it over the last 10 years, with this high alternative quota, and compared it with a traditional pension fund portfolio, which consists of equities, fixed income, and real estate. And short answer is yes, it was worth it. After fees, our coverage ratio is more or less 1% higher per annum, so 10% better returns compared to a traditional 60-40 portfolio. And I think we're in a lucky position to work for a family-owned business, and we do have this entrepreneurial mindset also in the board of directors. I mean, I would never have this kind of strategy with my team if we wouldn't have the full support of the investment committee and the board of directors. So we are really aligned. It's a strategy we wanna have, and I would say it paid out pretty well in the last 10 years.
Indeed, it did. And for those that participate in the conference, we are happy to hear that a lot of the points that were made during the first module really are things that you implemented in your pension fund and that led you to success. Now, at the same time, we're in a world that's changing, and it's changed massively in the last 2 years, in the last 24 months. And the question, of course, is, in a world that's changing, what are the implications? What is changing and what are the implications? I'd like to turn to Sudhir, who has this truly global multi-pension fund worldwide exposure. Sudhir, what is the biggest change that we should pay attention to? What are the implications? Sudhir, you need to turn on your mic. We don't hear you. I'm sorry. Bottom left. Maria, can you intervene and unlock Sudhir, turn on Sudhir's microphone? Sudhir, go ahead. Your microphone is on now, but we don't hear you. Okay, well, your microphone is on, but we don't hear you. Okay, let me jump, Sudhir. Let me work on your microphone and jump on, and move forward, and perhaps ask a similar question, and you can jump in afterwards from Kostas. Kostas, what is, in your view, the single most important change for pension funds, and that we should pay attention to as pension asset managers?
In my view, from Greek experience that I do have, I do not have, an international experience as we manage pension funds, the Greek community of pension funds. In my view, it is exactly what Martin just described. The single change that is currently undergoing in the Greek space of pension funds is the introduction of alternative investing into pension funds due to change in recent law. Just by the end of December 2023, the law was changed, and the alternative investments took a larger part into the pension funds allowance that the regulation is in favor of. And this was a big success of the asset managers due to the fact that Martin just described, that they provide a decorrelation with the 60-40 traditional portfolio that we are all used to manage during the last 15 to 20 years. And we as Piraeus Group, we are ready for this change, as we already have a specialized asset manager in alternative investment. So we are ready for this new challenge in the Greek market.
Good to hear. Good for you. Good for your country, obviously, for the country.
Can you hear me now?
We can hear you now, Sudhir. Sudhir, so
okay.
same question to you. What is
I'm sorry about this glitch. Actually, I was, should I continue, Théodore, from here?
Yes, please go on. Please go on.
Okay.
Yes.
Well, I wanted to specifically focus on two items. One is sort of an immediate issue, which is resulting from whatever changes have taken place over the last 24 months. And that's, you know, sort of in the industry, everyone says higher for longer. Interest rates are higher and they're likely to remain higher for longer. And the other issue is much more longer term, but it's also much more systemic and fundamental. And that's sort of the emerging bifurcation of the global system. So let me talk about the first one, which has an immediate impact on asset allocation. And I was actually quite interested to hear what Martin said about reducing his fixed income allocation to 0% and moving it to alternatives and so on. And coincidentally, as it happened, I was listening into a talk by Federal Reserve Board Governor Christopher Waller yesterday. And the indication was that the Fed is not in any hurry to reduce rates, although there is expectation in the market that there'll be rate cuts in 2024. But, you know, the point was made that core personal consumption expenditure is 3.2% over a year-over-year number as of November of last year. They will look at that very carefully. The economy is humming along nicely. Financial conditions are still a little bit restrictive, but there's no real urgency felt in terms of reducing rates. What does that mean? It does have some implications for different asset classes, clearly for fixed income, especially if long-term rates turn real for the first time in 20 years almost, starting from the dot-com burst all the way to, you know, until a couple of years ago, or basically. That has implications for fixed income, but it also has implications for the valuation of all public markets. And in fact, also for private equity, because a lot of private equity returns, people realize, particularly in the US and Europe, have come from the leverage, using very low cost credit, which was abundantly available. So that has implications in terms of asset allocation, especially if, let's say, even if rates go down, they settle down at around long-term 3.5%, something like that, with some positive real rate component, which has not been seen in the markets for a long time. It also has implications for what is loosely called LDI kind of sort of approaches, wherever a pension fund is overfunded or fully funded and is fairly mature or closed, in many cases, DB funds that are closed, particularly in the UK, where all of a sudden LDI type approaches suddenly become relevant and interesting to look at. So those are sort of the immediate issues in terms of asset allocation. The longer term issue is really sort of the bifurcation, the emerging bifurcation of the global system. And one of the very interesting tidbits of information that I recently learned was how about $50 billion of foreign portfolio investment has permanently left the Chinese market. And that's partly a response to all the geopolitical tensions that investors are witnessing, but also a response to regulation, certainly in the US, in terms of restricting investments in the Chinese market. What implications does that have? And Related to that is, again, an emerging phenomenon of de-dollarization. There's a lot more talk than action on it, but that is definitely very much on the radar of a lot of investors around the world. And those are paradigm shifts in terms of how we've thought about asset allocation, a globally integrated market, and so on. If this bifurcation were to really happen, and again, a recent data point, Chinese exports to the global south, the so-called, the way it's called, the global south, just surpassed their exports to developed countries. Wow. What does that tell you in terms of, how the center of gravity is shifting, and if it truly were to become two systems, how would that affect investors? So I just wanted to table those, and perhaps there'll be other people who will react to it.
Huge changes, and hearing the word de-dollarization from where you sit in Washington, D.C. is certainly sort of a nuclear bomb in the financial system. I'd like to turn to Martin. Martin, are you ready to buy bonds? Having listened to Sudhir.
We were already ready before, so I think that's no. I'm fully with Sudhir there. Maybe some of you might know we had a very specific situation in Switzerland. We didn't have a risk-free rate. We had a rate-free risk. We had negative rates for almost 5 years. So and for us now, the increase in interest rates on a low level in Switzerland, the 10-year government is yielding at 0.8 at the moment. So it's not, but it's a huge shift. So I'm fully with Sudhir that liability-driven investment is more interesting. You can hedge a part of the portfolio. You can hedge some of your liabilities. And we already, we looked at our models 18 months ago when it started to happen. And we were questioning ourselves, do we need to make a fast change of strategy? We then decided it's not something that will go away in a month or two. So we did a whole ALM process last year. We finished it end of November. And one of the results is that we doubled our fixed income quota. But I mean, it's still very little. It's from 5.5 to 11. As mentioned, an average pension fund would have 35, 40. So we are still very strong believers in alternatives and private markets. And maybe also to Sudhir's point, one tendency we also see is that in some sectors the private market is becoming more important than the public market, and one has to also challenge or ask yourself, what does this mean for my portfolio? So I mean, I think we would all agree that private markets have won, especially over the last 10 years, a lot in weight when it comes to capital allocation.
So that's great. We're getting now, and I hope everybody who's active here in actually managing assets, I believe we're getting some fantastic actionable advice on what to do. I'd like to touch on two other points, right? One, which is dear to me, is asset allocation modeling. We just heard the world has changed. It is changing. Can we use the same allocation models? We heard Arun before tell us, using mean variance is absurd based on historical data. Does any one of you agree with that? Kostas?
Yes, in my view, yes, okay, of course, the old Markowitz, the traditional Markowitz efficient market hypothesis is, of course, in my view, very old-fashioned at the moment. There are factor investment models, total portfolio analysis. What we really like is the dynamic asset allocation modeling, which is driven by changes in risk tolerance every year and every other period of time, difference in terms of risk tolerance. This is typically induced by cumulative performance relative to investment goals or an approaching investment horizon. So we could also link this to the ESG issues. So the dynamic asset allocation modeling could introduce an additional source of estimation errors due to the need for dynamic rebalancing. As I described, the problem with the war in Ukraine should be input into this model, so we could easily move out from low yielding assets into other kinds of sectors, let's say like defense tech sectors, and outperform the market. And what I would really just as a closing into this modeling discussion from our personal view here in Piraeus Asset Management is to pay a lot more attention into participants' flows. It is, I know it is a factor in the factor modeling, but by itself, in my view, and this was proven very well during October, whereby the supply and demand curve for treasuries turned a lot in favor of supply, and we had a real meltdown in the 10-year treasuries. They surpassed 5% in yields. So the market overshot, not because there was an increase, a rise in inflation, or there was a very strong GDP figure in the US, but because of the supply and demand curve for treasuries just before Yellen put things really, under a new equilibrium. So this
in the treasury market indeed things that are highly unusual, right? The last
yes. So this overshooting can only be analyzed through participants' flows. It is gaining very much traction against other factors.
Well noted. We have just really a couple of minutes left. George, please pitch in. I would still like to talk about the issue of scale and also get Sudhir's perspective on how his global membership, which includes some of the world's largest pension funds, is reacting to the changes. George, are we okay? Do we still have 2-3 minutes to address this? Do we have questions from the public otherwise?
Yeah, sure, Theodore. Some questions from the audience are also coming in, so I'm forwarding them.
Okay, well, please send me the questions. In the meantime,
Sure.
I'd like to hear from Sudhir first, and then I will talk about scale.
Sure.
I'd like to go back
Sure.
to Bernard about scale at the European level. But Sudhir, what are you hearing from your members? They manage billions. These are super tankers that are difficult to move. Are they looking at asset allocation models the way Kostas advises? How are they reacting to these changes you described?
I think there, at this point, there is more increasing awareness of the changes, and there's a lot of discussion. I'm not sure it has translated into action at this point. Now, certainly on the higher for longer, yes, there is a greater appetite for looking at liability hedging related sort of strategies, which were completely off the table when no one wants to lock in 0% and 1% interest rates for any kind of strategy. What are you're not really getting anywhere with that. Now there is definitely more discussion, more conversations around it. I think they're still waiting to see where things will stabilize, because we think the future is going to be just like it has, what we've experienced in the very recent past. So there is a certain percentage which thinks, oh, this big spike up in interest rates is temporary and it'll go down equally rapidly. And I think it'll take some time for people to get used to the idea that it may not go down rapidly, and it may in fact stabilize at a much higher level than it has in the past, barring, of course, another big crisis of some kind. That's possible. The other one, in terms of the whole China issue and all of the tensions, that is, again, it is registering on in people's conversations. How to deal with it remains an open question.
Very clear, and I'd like to focus on 2 more success factors that have proven, at least in the past, and how they can be applied. ESG and scale. Starting with scale, it was mentioned during the conference, and many studies show it, that despite Martin beating everybody with a 2 billion fund, and congratulations again, Martin, that on average, scale is an advantage. It was mentioned by a number of the speakers, including Luba, Louise, Rob, Timo as well. We have an issue in Europe because there are no pan-European asset pools. Although, again, we had a regulation 20 years ago that aimed to allow it. It was revised 15 years ago. And apart from a few Belgo-Dutch asset pools, nothing has happened. I believe this is a very important issue for Europe. It's holding performance back. Bernard, is the EU aware of this? Again, a regulation that didn't work. And how can we hope to have scale at Europe-wide at in the pension fund asset management world?
Yeah, I mean, I fully agree with your kind of overview, summary of the situation. I mean, the IOP, so-called the IOP directive, was created 20 years ago, and it's a failure. I mean, there are only 31 institutions engaged in cross-border activities, and they are managing 13 billion, so 1.3. So it's just, you know, nothing, right? The problem is that, you know, IOPA is aware of this. As you may know, this directive now is should be reviewed. But actually, the European Commission, you know, has decided to postpone the review. The review should have been done last year. You know, the Commission has decided just to postpone the review, but still ask IOPA to, you know, to analyze the situation and to provide an advice to the Commission. And the report of IOPA is quite candid, you know, it's kind of addressing your question. It's also based on feedback received from member states. And believe it or not, I mean, the majority of member states, I mean, indicated in their conversation to IOPA that they are happy with the current directive and the state of play in the cross-border business. So only 6 member states consider that the existing procedures, you know, are too complex. The problem, Théodore, is that I think member states are aware of this, but they really are focused on their own countries, their own industries, their own sailors. They are afraid that the assets that could be pooled, you know, from a number of national pension funds towards a single pension fund in another country, you know, would leave the country. And the supervision of these assets would be more difficult for the national authorities. So by, you know, not seeing the bigger pictures and the opportunities that you mentioned, they are likely to stop, I mean, any meaningful review of this directive. IOPA agrees with this conclusion and consider that just really to create this market where you would have scales, you need to go beyond the directive, beyond the framework of the directive. And for instance, I mean, one idea that has been floated is to create a new so-called second regime for pan-European pension funds that could operate outside. And one big issue also are the social and labor laws, like in the taxation field. This is as important for member states. So, but, you know, those are interesting proposals, but I'm not very optimistic that they could be adopted, and the discussion will continue for many years, I'm afraid.
So we'll have, well noted, so I guess in Europe we'll have to replace scale with smarts, like Martin is doing, outperform with a smaller fund. Let me turn to George. He tells me there are questions. I just saw one here. Pensions are there to deliver returns to pensioners. Integrating ESG in portfolio construction may not help this because it shrinks the investment universe, a comment we heard from Timo, by the way. In your view, should there be a pressure by regulator supervisors to adopt ESG criteria in asset management? So I'm not sure if there should be, because there is huge pressure already. So I guess the question is, should the debate between self-regulation and top-down regulation, I think we addressed this before with pros and cons. So I don't think we need to come back. We heard the state of play. The speaker in the previous session avoided replying to the question whether pensions should be taxed. What is your view on this? Obviously, taxing pensions does not help the development of occupational pensions. And in addition, it may not be ethical to tax pensions, given that pensioners do not receive labor income once they retire. Again, question is noted. I don't know if anyone has a comment. This is really a tax specialist issue, which I'm not. I think the issue here is that contributions, the concept of PEP, what I heard, Bernard, is contributions are tax deductible in PEP, but member states don't really recognize this tax deduction uniformly. And at the same time, pensions are taxable against this tax deduction, but again, there is no EU-wide such EU-wide agreement on this. So we're basically stuck, right?
Yeah, I mean, yes, and some part of the contribution may be may get a tax advantage, not necessarily, a huge amount. One condition also for the PEP to be able just to compete is that the PEP should, as a new product at the national level, receive the same tax advantage that is granted to the existing product, right? It's already, being to have a level playing field, and this is not yet the case in many countries.
Catch-22. One question we have from my friend Christian Dreyer. Christian, welcome. Christian is former chairman, president of CFA Institute in Switzerland. We've collaborated on a number of events. I cite his question. AQR suspects that pension funds overpay for private equity because they like the smoothing effect, whereas the returns could be replicated by 1.2x leveraged Russell 2000 exposure. We have here several practitioners of private assets. Martin, should we just toss out the private equity and replicate with a 1.2x leverage Russell 2000 exposure?
First of all, I mean, by Swiss definitions and Swiss pension fund guidelines, we couldn't. It would be a challenge, or even we would be not allowed to invest a 1.2 leveraged Russell exposure. And I'm always a bit skeptical when it comes to replication strategies. We've seen that in the hedge fund space. I know hardly any replication strategy that really delivered the result that we were expect to get, especially on a Sharpe ratio basis. I see a bit the same when it comes to private equity. It might be true on average, but if you compare your own portfolio, if I look at our portfolio with a tracking record of around now almost 20 years, we're way ahead of a 1.2 leveraged Russell 2000 exposure.
Well noted and well done. Any other comments on that?
Yeah, Théodore, I can comment on that. Can you hear me?
Yes, absolutely. Anxious to hear.
Okay. Yeah, no, in fact, it goes back to the earlier question about scale and the benefits of scale and so on. If you combine scale with good governance, you can actually do a lot, because it's widely recognized that in-house management of assets is much lower cost than management through external managers, external agents. And if you have the right kind of scale and good governance, I want to emphasize this issue of good governance, you can also do direct investments that can address the issue of private equity costs and all of those related sort of concerns. So you can get, and also in terms of really extending the investment horizon for those kind of assets, because there's no reason why you need to be constantly on this treadmill where you've got 10-year funds and then you're constantly trying to reinvest and paying fees in all kinds of ways, including front-end fees and transaction fees in terms of investment, as well as liquidation, realization, and so on. So scale does matter, but scale by itself is not enough. Scale together with very good governance actually makes a difference. You can see that you have scale in a number of jurisdictions, including, for instance, US public pension funds. But if you don't have a governance structure that is designed to take advantage of that scale, as for instance it is in Canada, you see a big difference in terms of performance amongst the, if you compare the performance of the large Canadian pension funds relative to other public sector pension funds which are equally large or even bigger.
I hope regulators attending the conference are listening to this part of the discussion. Let me turn to George. George, do we have any more questions? I see one here, a closing question on a view on robo-advising. Are we all going to be replaced by robots? Kostas.
We are delving into this new entrepreneurship. We have already set some standards. We haven't yet implemented any robo-advising into our asset management practices, but we are looking really deep into this, but I do not have a clear opinion to answer the question. Sorry about that.
Thank you, Kostas. I guess this closes the panel. I want to thank everybody. George, do we have one last word from the panel, or over to you?
I think, yeah, I think we're just on time. So thank you, Théodore, and many thanks to all 4 panelists.
Let me thank Sudhir, Bernard, Kostas, Martin, truly honored by your participation. And I am convinced.
Thank you very much.
Fulfill the expectation of discussing timely, relevant, and debatable topics and providing actionable advice to participants. So, George, over to you.
Thank you, Théodore.
Thank you. Bye.
Bye. Thank you. Great panel.
Bye.
Thank you.
So this brings us to the end of today's conference. I hope you all enjoyed it. As you may have noticed, we touched upon a number of themes ranging from regulation to robo-advising, fintech, best practices, alternative investments. So all these topics are very timely in the domain of asset management for pension funds. Let me once again thank our valuable sponsors. We view sponsors as an integral part of IFFR, and we view them as long-term collaborators. So may I thank our platinum sponsor, Piraeus Asset Management Company, our silver sponsors, Alpha Trust, Eurobank Asset Management, NN, Systemic RM, our supporters, Hellenic Fund and Asset Management Association, CFA Society Greece, and the University of Piraeus. May I also thank our media partners, Business Daily, Capital GR, Euro Today, Next Deal, and C'est La Vie. May I also remind to you that the questionnaire for today's conference has been emailed to all of you. So we will very much appreciate your feedback. Your feedback is very valuable to us so that we continue providing high quality services. Last but not least, I would also like to thank Maria Giuli and the whole IFFR team. As I said at the beginning, many people have worked hard to make this conference a success, I hope. I have just been notified that more than 350 delegates from all over the world have joined us today. So with that, I would like to thank you all, wish you a happy new year, and please stay in touch. We're going to inform you on our future activities. So good afternoon or good evening or good morning, depending on where you reside. See you soon. Bye-bye.